when do you think the cycle peaks out at?
Well, I think it peaks. I mean, our view has been it peaks somewhere around late 2025. It may be, in other words, sometime in the second half.
Crypto fam, welcome back to the channel. As you just saw right there in that clip, that was Michael Howell and Raoul talking about when they believe the crypto cycle, the financial cycle, will end. And in today's video, we'll be checking out a recent discussion these two had. And if you don't know who Michael Howell is, he's the managing director of Cross Border Capital. It's a research and investment company that he founded back in 1996. So he's been very involved in the financial markets for a very, very long time. And in today's clip, they're going to be talking about global liquidity and how to spot it. Also, what happened in Q2 with global liquidity and why we got a sell-off in Bitcoin. And when they believe this liquidity cycle will peak, which could potentially be when Bitcoin peaks. You guys see these charts right here. These are the liquidity charts that Raoul Pal shows a lot. And Bitcoin is highly correlated to the liquidity cycle. And you can see that right here in these charts. So a lot of key information in today's video. I recommend you guys watch this one all the way to the end. And if you guys want to get any in-depth research and analysis on what's going on in the crypto market, make sure to check out our Patreon. Let's go ahead and check out the clip here.
And how we understand liquidity is basically money has a hierarchy. So it's a question of understanding, how that hierarchy evolves. And what you've got, if you think of it in terms of a pyramid, or maybe an inverted pyramid, what you've got on the apex of the pyramid is basically central bank balance sheets, or let me be more precise, the liquidity creating parts of the central bank balance sheet, because it's not just the balance sheet that's critical. Then you've got to factor in what can be maybe borrowed offshore. So you've got to think about, certainly it was a relevant element maybe 10 years ago, the Eurodollar markets. They've sort of been eclipsed in many ways in the last decade, but they may well come back in a different guise. So in other words, those offshore deposits. And then you've also got to start to wrap in collateral, because certainly since the GFC, collateral has been a very important part of any liquidity creating process. Now, on that apex, what you've got is a pyramid that grows, and the base of the pyramid consists of private sector liquidity. And that private sector liquidity is really a function of the apex, if you like, the central bank balance sheet and the collateral. And you have a collateral multiplier or a shadow banking multiplier that effectively energizes that core money and drives it into credit globally, which is what we think of as global liquidity. So that's what we tend to look at. Now, if I have to drill down and say, well, okay, I'm on a desert island, I've got to choose maybe three things to look at. What are the three most important things? I would say number one is what the Federal Reserve is doing with its liquidity injections. The Fed is clearly the preeminent central bank worldwide. Secondly, though, you've got to look at the People's Bank of China. People's Bank of China is critical to understanding the China's footprint in the world economy. And we know that is, effectively, without mixing metaphors, the elephant in the room. So China has got a huge footprint in terms of the world economy, and the PBOC largely controls that. And then you've got a third factor, which is really understanding how collateral markets work. And one of the best ways to gauge the impact of collateral is to look at something like bond volatility measures, such as the move. So if you've got three traffic lights, let's say the Fed, the PBOC, and the move index, if you've got an expanding Fed balance sheet, an expanding liquidity injection by the PBOC, and a move, in other words, bond volatility that is shrinking or going down, then that's a recipe for very strong global liquidity. What you've had in the second quarter is you've basically had the Fed tightening liquidity, and that's really been a simple fact of the Treasury General account going up because of the tax paying period as of end of April, 15th of April. So that tax paying period meant that TGA jumped, and that sucked liquidity out of US markets. And it's only just starting to come back again. So one of the ways that, as I say to people, if you want to monitor that, just look every Thursday at 4:30 Eastern time and look at the Fed H4.1 press release, and that will give you everything you want to know about what's happening to bank reserves, etc. And I would imagine they're going to keep moving it higher, but let's see. So that's number one. Number two are the People's Bank of China. What is it doing? Now, it's been very concerned about the yuan. The yuan has been weak It's been trying to hold it up, and it's tightened monetary policy since the end of the Lunar New Year to date to try and hold the yuan. What it's done in the last 28 days is it's injected 600 billion yuan back into money markets, which is actually quite a big move by the Chinese. So it may be that either accepting the fact that the yuan's got to devalue a bit more, or there's some deal that's being cooked that, as you were discussing, that maybe there's a deal with Yellen or the US is going to start to ease. But, take it from, a comment that Lagarde made from the ECB. She said, I think a matter of 2 or 3 days ago, that US and ECB policy are not going to diverge very much. Or actually, I think she even said rates are not going to diverge very much. Well, they're keen to start cutting rates. The Swedes are saying they want to cut rates. The Swiss have already done it. So I think what you've got is an environment where central bankers are basically already saying they're going to be cutting quite aggressively in the course of the next few months. The Fed may not go wholeheartedly in there, but I still think there's a cut, and a cut may come as early as July, I think, because I think the
I'm the same. I think it's underpriced as the July cut.
Yeah. So, we're in a situation where you've got the US, which I think is going to start easing, where the PBOC looks like it is, but that's really an uncertain factor depending on the currency. And then you've got the MOVE index. Well, what Janet's doing is improving bond market liquidity, which is pulling down bond market volatility, improving the collateral multiplier. So you've got another potential green light. So I would imagine that in the course of the second half of the year, I think liquidity is going to start to spurt higher. I mean, I've gone on record of saying that I think the liquidity component of the Fed balance sheet could be rising at a 20% annualized clip through the second half. Part of that's seasonal, I grant you, but it could easily be because they actually want to get the dollar down. And they've used the TGA in the past at times to try and weaken the dollar or talk the dollar down. So I think that all that's feasible. And then, as I say, watch China, because that's clearly the elephant in the room when it comes to liquidity. And we know the Chinese economy is weak. And one of the charts I put in to the pack I sent was a very simple chart that looks at PBOC liquidity injections and the change in the price of iron ore. Now, iron ore is a pretty fundamental commodity to the Chinese economy, and the correlation is remarkably close, with a lead time of about 2 or 3 months on Chinese liquidity. So if the PBOC injects liquidity, you're going to get a turnaround of the world economy. And all the evidence seems to point now is a cooling in the world economy, not a recession by any means, but a cooling. And the very, very best time for risk assets, as you will know, is when you get a sluggish economy that central bankers want to stimulate. And that's what we've got now.
When do you think the cycle peaks out at?
Well, I think it peaks. I mean, our view has been it peaks somewhere around late 2025. It may be, in other words, sometime in the second half. And I think that's really a combination of probably 2 or 3 things. One is that, in my view, inflation is still very sticky. I'm not a high inflation person, but I do think it's sticky. And I think that may well color Fed thinking or central bank thinking at that time. The second thing is I think the economy by that stage will actually be pretty good. I mean, one of the questions we haven't asked is, where are we in the cycle? My view is I think we're actually relatively early cycle in the world economy. I don't know your view, but that would be
exactly the same. I mean, the ISM's barely turned up.
Yeah.
I mean, we can't be late. We can't be mid. It's about 50 right now. It's just coming up.
Yeah, exactly. So I think you're going to get a much stronger economy through next year.